Hello everyone, welcome back to the channel. This is Fair Value Finder, and today, we're going to be taking a pretty quick look at Eagle Materials Incorporated, ticker EXP. This one, kind of the opposite of what we usually look at. The fundamentals aren't too bad here, but the growth rate just isn't there, and it's undervalued, likely because it's expected to grow at a pace less than you would expect from the market. What we're looking at here is a fair value of just north of 220 and an actual value currently of 215. And when I first started analyzing this stock, it was quite a bit lower. It was about 196. And at that time, I decided that I wanted to do a put credit spread. And I did collect $100 in premium, a $185 strike. So definitely looking really good on that. That expires later this month. So I will be happy to have collected $100 off of deciding to analyze this stock and figuring that it was undervalued, and then reading the technicals and determining that it was at a bit of a low point, set to start rising back up again. So that's the story on this one. I personally wouldn't really consider investing in it because, as you can see, our returns 5.6%. Once you factor in the dividend, you're getting 6%. So it's about 2% under what you'd expect from the market. So you're giving up about a quarter of your expected gains. And we've looked at some other stocks that are significantly better where you can get 2 to 3x that return. Usually those stocks are overvalued though, and this one is undervalued. It was better when I first started analyzing it. It's just a bit now. Fundamentals are solid though. So we'll get into those. Earnings yield 8.4%. We'd expect 10.76 for EPS for what we're paying, and what we're getting out of it is $13.88. Expectations for this year, $14.06, and next year, $15.63. So they definitely beat out the earnings yield that we were looking for. Cash flow yield this year was down. It's usually around 19.8. They were at 15.6. Still super solid on cash flows. Dividend yield super low, payout ratio super low, so there's definitely room for them to grow that. We can take a look at the quick history real quick. They initiated it in 2022 and are growing it. Looks like there wasn't really any growth this last year, so we'll see if they decide to just hold out or what's going on with that. Might be early days for it to be a dividend growth stock, but they did grow at 10% over the past 2 years. ROE is great at 31.78. Debt to equity is just a bit high at 1.24. Not too bad, just $351 million that if they can grow their assets, shrink their liabilities, they'd be in a better place. Return on investments, really good, 15.34, and return on assets, 14.2. So, I mean, everything fundamentally here looks good. Just a smidge high on the debt to equity. Gross margin, right around 30%. They're usually around 29.5. Net, 20.5. Usually in the upper 20%, just shy of 21 on their average. PE ratio currently sitting at 15.31. That's a good PE ratio with a earnings growth rate of 11.2%. Giving them a price to earnings growth of 1.37. So earnings wise, I mean, it's not the best. They have really high EPS to begin with. So I'd assume that they don't have too many shares. And it definitely looks like a pretty low number there. So fundamentally, I give this a thumbs up. Now we need to see, what do we think is going to happen? What do analysts think is going to happen? And what kind of growth would that give us? So revenue hasn't been amazing. 6.71 over the last 3 years. Over the last 2, it slowed down a lot to 1.7. Analysts are projecting 1.8 this next year, and then over the next 2, 3.7. So on the higher end of that, giving them a 3. I mean, we can give them best case scenario to begin with, 3.7. That's what analysts are giving them. Share count, I mean, they buy back shares. Over the last 3 years, 5.21. Over the last 2 years, 2.7. So again, let's give them. Okay, 5.21 is going to be too much of a best case scenario. I think 2.5 would be a pretty fair estimate here. Maybe a bit better of an estimate would be 2.7, 2.8. I don't think we're going to see a 5.2 here again. Cash flows. Well, if the revenues are growing, we'd want the cash flows to maybe slightly outpace that, get back up towards their average. Assets, 8.2, 5.5. 5 is definitely fair. We'll go with 5.5. Liabilities, 7.73, 4.26. So 4.26 there would be the better case scenario. Dividend, after this last year, I'm not expecting growth out of them. If we want to go with the best case scenario, we go with they grow at 10% and get up to a decent dividend payout ratio. And then margin-wise, they seem to hold pretty steady at those margins, so I wouldn't expect much there. So with our slightly improved thesis, we do get better returns towards the lower end of what we would expect from markets. We're really looking for that 8 to 10%, and we're getting 8.4, 8.9 once you factor in the dividend. You're definitely not crushing markets. So really, I don't know what kind of portfolio this stock would belong in. It's not a massive dividend stock. It's not a high growth stock. Maybe if you want exposure to the materials sector, you think there's going to be an uptick in that sector that could cause this company to outperform the thesis here. That could be a reason. But I'm just using it as a trade because it had a really good premium. So let's just take a quick look at everything mapped out here. Dividend was non-existent, and now that dividend is worth somewhere in the realm of $200. And then the balance sheet is just steadily going up, definitely lagging behind everything else, though. The share price took a dip in 2023, back up in 2024, right towards where we'd like to see it, right in between everything. You have your fair value, your earnings, your cash flows, and your dividend all in this tight space in 2025. I'd like to see the share price kind of below the fair value. And my fair value calculation on the summary page takes into account future growth. So next year's expectations and the discounted cash flows and everything else. So that's why it is showing a bit higher and why it looks like the share price is higher than the fair value at this moment. I really don't know how to classify it. We could try and go a worst case scenario, just make sure you don't go underwater and see if it's just kind of a safer, I don't want to call it a blue chip stock, but something in that realm. So revenue growth on the lowest end is about 1.7, and the share count, they could buy back nothing. Cash flows, minus 6.5. Assets, 5.5, with liabilities at 7.73, dividend at 0, margins at nothing. And that would give you an average annual growth of negative 0.6%. After you factor in the dividend, it's negative 0.1. Mostly driven by those cash flows shrinking. If we say that the cash flows stay in line with the revenues, though, then you're looking at kind of minimum growth of about 2%. So what we're looking at for this one, something in the realm of 2 to 8% for annual growth and the fair value somewhere in the realm. You see when we dropped these, that dropped a little bit. So somewhere in the realm of 220 to 225, which is a pretty tight range, but it didn't budge a whole lot as we shifted numbers around. And the only real concern is the balance sheet, which really isn't even that much of a concern. It just could be better. And that's really all I've got for this one. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.